In this video, guys, we're going to look at the teacher who lost 280k spread betting, and for context, he earns 18. Stay tuned. Hey guys, welcome to you. So I've got an issue with this story and I'd like to share my thoughts with you, and I also would be interested to hear your thoughts on this as well. So there is a story in the Independent, it's been in the Telegraph, it's been in all the kind of UK press, and I'll stick a clipping of it up here now, which talks a long time ago, a few years ago now, about a teacher. The headline is, "Teacher loses 280k spread betting." It's all about one of the spread betting providers. It's all about this, all about that. And the kind of theme behind it is really one of negativity towards spread betting. And it starts off, the article starts off with a guy who's lost, a few £1,000s on the Swiss. And just for kind of context before we go into that, just remember this 120 ceiling versus the Swiss franc, the Euro 120. The Swiss franc versus the Euro 120 ceiling was scrapped by the Swiss National Bank, and we caused that massive spike to the downside. Remember that, I'll stick a clip of it here, actually, this screenshot. So remember that. That caused a lot of people who were long on that market or on that chart to be hammered because the stops weren't triggered. They kind of had lots of slippage, loads of reasons, as you know, if you understand how the whole thing works and stops and market orders work, why that happened. So that's the context of why this article was written. And there was the first part of the article was a guy who lost 1,000, 5,000, 7,000. He was watching it and he was worried about it. I thought, okay, that's probably the order of magnitude that you would expect for your average trader who's maybe not a professional trader, maybe not actually trading aggressive size, just trading, a bit of part-time money, but a little bit more is probably, that's a stinging impact, right? It's something extreme move, bit too much leverage, perhaps. You kind of get that. But then the next part of the story was talking about this teacher who earned 18k, around 18 grand, who lost 280k. And the whole final theme of the story is, oh, look at this is horrible, blah, blah. And yes, listen, don't get me wrong, it's not pleasant for anybody to lose money. However, when the story went on a little bit further, it later said that he was trading basically £100 per point, or pounds per pip. We're talking about currency. So spread betting, for every pip move, he was trading £100. Now, the problem I have with this story is it's villainizing spread betting as a way of expressing a trade in the market. It's a way of trading the market, a vehicle to trade, should I say. It's kind of villainizing trading in general. But for this guy, I mean, listen, we don't know his financial situation. We don't know, maybe he makes good stories there, an 18k a year. Perhaps he's worth 25 billion and, it's irrelevant. But let's assume that a guy on that kind of money probably hasn't got millions in the bank. Let's just make that assumption, rightly or wrongly. So for him to be trading £100 a point on something, to me seems like that's him over leveraging. That's him gambling. That's him trading from a perspective of no acceptance of the risk. He's not looked into the risk at all. I mean, whatever 18k is, a 20-point move on that would be more than a month's wages. So something's not quite right here. This guy had a bit of a problem with his trading, and he's trading £100 a point. But the important lesson from this is risk, guys. There doesn't seem to be any reason why somebody with that, on that level of income, and again, could be making assumptions here that this is completely irrelevant and he's got a large pot, in which case, fine. If he can stomach that loss, then that's absolutely fine. But the kind of moral of the story, if we relate it to everybody kind of watching and the normal trading community, of trading within your risk acceptance level, what's acceptance and what's okay for you. £100 a point when your net worth around that kind of level is too much. 20 points, you've lost a month's worth of weight. Now, even if, okay, we'll kind of add a caveat here, even if the guy did have a big chunk of money, then mentally losing what he works for a month for, in 20 pips, guys, is nothing, right? Absolutely nothing. Appreciate it was a little bit different for the Euro Swiss because it was a very small margin, and appreciate that the volatility and the range was very small, so the size would have to be increased. But there is that risk of, hey, stuff can move, 20 pips quite easily, 30 pips quite easily. And so you get to a point where if you're working all month and you're losing that and you've got 20 pips at stake, it doesn't make sense. So what we need to think about is when we're trading size, we all want to make as much money as possible with the least amount of risk as possible, but we also don't want to go into a place of acting from fear. We don't want to a place of acting from greed. To me, £100 a point seems too much. And if we look at it and we forget about this guy and we forget about all this kind of story and stuff, and we look at it in perspective of how much you're risking relative to what's comfortable for you, this is a great lesson. Because we should be risking, we all want to kind of press and we all want to kind of trade more size, and we've talked about this before where we want to stretch to the level that's uncomfortable, then back off. So increasing our position size to slightly uncomfortable, so we're kind of using a different portion of our mind, then backing off that. So that's how we stretch our position size, assuming we're making money and we've got a reason, justification to increase our position size. If we haven't, we shouldn't be doing it anyway. So the one thing, couple of things to take away from this, guys. One is, what's your position size? You know, this, if you're earning that, if that's true, and we've, like I say, we've got to make some assumptions here, it's too much. Even though the chart was kind of very, very narrow and the ranges were very, very narrow, it still seems an awful lot. And of course, now he's saddled with that kind of debt. I don't know what's actually happened with that, whether IG have written it off or whatever it may be. But the point is, yeah, look, this is a bit of a warning sign. Things do happen. And when you're fully leveraged up and you're trading from a kind of perspective of just looking at the reward, and I'm sure he went in and looked at, well, I can make a couple of grand out of this, you know, I could do this without looking at the risk. Whereas you notice the twist and the pivot in people's minds. If you look at any of the hedge fund market wizards, you read any of the books by hedge fund managers, you listen to the listen to the podcast, etc., they're all coming from a perspective of, where's the risk in the deal? Where's the risk? I'm a risk manager first. I need to cap the risk. Once I've capped the risk, then I can start to look at where this could go, where this could potentially go. And they change the frame. And there's something along the journey of traders that flips them from this kind of trading of, I'm just going to punt, I'm going to hope to make 5 grand, 10 grand on this, to, all right, where's my loss? And then when that changes, things start to change. You start to look at trades in a different way. There's no way that that guy would likely look at that trade again in the same way if he was focused on risk. He'd be like, well, what happens if this does suddenly move? Forget about the peg. What happens if it does suddenly move 20, 30 pips in a day? You know, I'm going to be hammered on this and I don't want to take that risk. And so he wouldn't have taken the trade, or if he did, he'd have dialed the risk right back and gone, okay, I still believe it's a trade, but I need to allow for that kind of tail risk that's coming in. Forget about the tail risk of an extreme scrap of the 120 ceiling, but the tail risk of just moving a little bit more than it normally does, a kind of wider ATR than expected. 2 or 3 times average true range in a day on any market isn't unusual, guys. We're not talking about a kind of multiple standard deviation occurrence here. It happens regularly, so expect it. So anyway, guys, I wanted to bring that up. I wanted to kind of talk about it because I've seen this article comes up loads of times, especially when you search on Google for bits and pieces, and I thought, you know, it's worth addressing this. It's worth kind of saying the lessons from it and kind of having a little bit of an issue with the article, the way it's framed around, perhaps making it look as if it's a dodgy pastime to be trading. And yes, we know there are people who are using it as a gambling vehicle. We know people are using it in place of a casino or a slot machine or a fruit machine or the horse races or the greyhounds, whatever it may be. And that's a different segment. But then there's us, who are taking it seriously and are accepting the risk, managing the risk in a prudent manner, and are looking to grow our equity curve over time. All right, guys, whatever you're doing, take care. I'll see you in the next one.